Do you know that the world's richest investor, Warren Buffett, says that 15% of his success comes from Philip Fisher, a person who is considered the father of value investing? In today's one video, we will completely decode the most powerful book, Common Stocks and Uncommon Profits, from our Top 10 Books of Stock Market series. Today, you will learn that mysterious 15-point checklist, which if you apply even on a big stock will expose it. Fisher's Scuttlebutt technique, which will turn you from an investor into a top-class detective of stocks. And the biggest suspense, what is that one situation when you should almost never sell, no matter even if the market crashes? And in Chapter 6 and 9, Fisher has said some things that can save your portfolio from big future losses. If you want to be among those few people who earn uncommon profits from the market, then this video is going to be the most important investment of your life. Chapter 1. Clues from the Past. When Fisher was observing the market closely, he found two types of investors. First, those who tried to catch market ups and downs, bought in recession, sold in boom. Fisher says this sounds very easy, but in reality it is a gamble, because no one knows when a recession will come and how deep it will be. But Fisher's focus was on the second path. He saw that in the past 1 century, those who created the most wealth did not catch the market, but companies. Such companies that came out stronger after every recession. From here, he got his first clue. Real wealth is not hidden in market fluctuations, but in the tremendous growth of a company. Now the question was, which companies were those? Fisher turned the pages of the past and found that in the DNA of winning companies, two things were common. First, R&D, it is research and development. Fisher believed that a company that does not spend a part of its earnings on future technology and new products will soon become history. And second, honesty and vision of management. Fisher says that if management is only thinking about next quarter's profit, then it will earn only ordinary profits. But if management is preparing for the next 10 years, then it will give its investors uncommon profits. Here, Fisher says something that was against the big experts of that era. He said, do not buy just because it's cheap. In that era, people were crazy about low PE ratio. But Fisher taught that if a poor company is available cheap, then it is a value trap. Instead of that, choose a company whose sales and profits are growing at a rate of 20 to 30% year after year, even if its PE is a little high. History is witness that quality always beats price. If there is strength in the business, then today's expensive stock will become tomorrow's biggest multi-bagger. The last and most powerful clue of Chapter 1 was patience. Fisher studied those people who multiplied their wealth thousands of times. He found that those people never rushed to book profit. Fisher has a famous mantra: if you have done your homework correctly while selecting the company, then the time to sell that stock is almost never. He observed that people who keep buying and selling repeatedly, their profits go into brokerage and tax, while those who sit quietly become millionaires. Chapter 2. What Scuttlebutt can do. In the previous chapter, we learned that we have to find growth companies, but the real challenge starts now. Anyone can read a company's annual report and balance sheet, but is the information written there the complete truth? Philip Fisher says that if you want to earn extraordinary profits in the stock market, then you must know what charts and numbers do not tell. And for this, he gave a unique method, which he calls Scuttlebutt method. The direct meaning of scuttlebutt is gossip or rumors, but in the world of investing, its meaning is much deeper. Fisher believed that the real picture of a company is not inside its office, but scattered outside in the market. Suppose you want to invest in a company. Then, according to Fisher, you should not only look at its profit, you should talk to that company's competitors, its ex-employees, and its suppliers. Fisher advises to ask questions like a detective. For example, If you ask a competitor of that company, what is that one thing that your rival company is doing better than you, then the answer you get will not be found in any balance sheet. If 5 different people are praising the same company, then understand that you have found a multi-bagger. Not only this, Fisher strongly emphasizes talking to employees. He says that if a company's employees are happy with their work and respect the management, then that company will definitely succeed in the long term. But if the people there do not like the management, then understand that the future of that company is in danger. The biggest beauty of the Scuttlebutt method is that you do not need to be a big expert for it. You just need to keep your eyes and ears open. You can ask yourself, do these companies' suppliers get paid on time? Are its customers really happy with its products? Fisher says that when you gather scuttlebutt, that is, information about the same company from 10 to 15 different people, then such a picture of that company emerges, which is 100% accurate. This is hard work, and maybe that is why 90% of investors do not do it. And this is the reason why those 90% people never earn uncommon profits. So, the biggest lesson of Chapter 2 is trust the data, but never ignore people and market discussions. Real diamonds are always hidden under dust, and to find them, you will have to get your hands a little dirty. Chapter 3. What to Buy? The 15 Points. In the previous 2 chapters, we understood that we have to look for growth and do scuttlebutt, i.e. investigation. But what are the concrete questions that we should ask a company? Philip Fisher gave us a checklist of 15 points. He says that if a company has all these qualities, then it is a gold for investment. Let us understand them in depth. First point, does the company have products or services for which there is so much demand in the market that its sales keep increasing continuously for many years? Not just one-time sales, but consistent growth. Second point, is the company's management serious about creating new products? When the demand for old products decreases, do they have any new plan ready for the future? Third point, how effective is the company's research and development, R&D? Just spending money is not enough. That spending should result in new and better products. Fourth point, does the company have an above-average sales team? Fisher says that without good marketing and sales, even the best product in the world can fail badly. Fifth and sixth point, profit margin. Does the company have a good profit margin, and is the management working to maintain or increase that margin? Remember, sales without profit are of no use. Seventh point, how are the company's labor and employee relations? A company where strikes happen or employees remain unhappy can never become a long-term winner. Eighth and ninth point, are the relations between the company's executives good, and is there depth in the management? That means if one top person leaves, are second-line leaders ready to handle the company? 10th point, how is the company's cost analysis and accounting control? Does the management know where every single penny is being spent? 11th point, does the company have any special strength in its industry, like a patent or any such quality that makes it different from others? 12th point, is the company's approach focused on long-term profit instead of short-term profit? 13th point, for future growth, will the company need to issue more shares? If a company keeps issuing new shares again and again, then the profit of old shareholders gets reduced, diluted. 14th point, does the management talk openly with investors during difficult times? Everyone speaks loudly in good times, but do they tell the truth even in bad times? And the last 15th point, is there no doubt about the honesty of the company's management? If the management is dishonest, then the remaining 14 points have no meaning. Fisher says that it is not necessary that every company passes all these 15 points, but if a company fulfills most of these points, then it will prove to be an extraordinary investment. Friends, these 15 points may sound a little difficult, but these are the filters that separate garbage from diamonds. But one big question is still left: when to buy, and more importantly, when to sell. Should we sell when the market is falling or when we are getting a good profit? Fisher has very interesting answers to this. Chapter 4. Applying this to your needs. In the previous chapter, we understood those 15 points that identify a great company. But should every investor invest money in every company that passes these points? Philip Fisher says no. In Chapter 4, he explains that investing is not a one-size-fits-all game. Every investor has their own needs, their own risk-taking capacity, and their own knowledge. According to Fisher, first of all, you have to identify yourself. He divides investors mainly into two categories. First category, defensive investor. These are those people who do not have much time for research or who do not want to take very big risks. Fisher advises for them such large and established institutional companies, which have been passing most of the 15 points for many years. Here, profit may grow slowly, but capital remains safe. Second category, enterprising investor. These are those people who can put in the effort to find small or new companies. Fisher says that real, uncommon profits are hidden here. Such companies which are small today, but whose management and product have the power to change the entire industry in the coming time. Here, Fisher gives a very big warning. He says, do not invest in a company just because it is in discussion or is a hot stock. Instead, see whether you understand that business. Do you have a way to gather scuttlebutt, i.e., information of that sector? Another important part of this chapter is diversification. Where many people say buy many shares so that risk gets reduced, Fisher was against this. He believed that instead of holding 25-30 average companies, it is better that you hold 5 to 10 such outstanding companies which you understand deeply. He says, too much diversification is a sign of ignorance. If you have done your homework of the 15 points correctly, then you do not need to be afraid. In the end, Fisher explains that investing should be a part of your own personality. If you are not able to sleep peacefully at night, then it means that you have taken more risk than your capacity or chosen a company that you do not understand. So the lesson of Chapter 4 is, identify your capacity, define your circle of competence, and then apply those 15 points to the companies that fall within that circle. Chapter 5. When to buy. Till now, we have understood how to find a great growth company. But in the stock market, just knowing what to buy is not enough. Knowing when to buy is equally important. Philip Fisher starts this chapter with a bitter truth. He says that most investors think that they will get a stock at the cheapest price. But in reality, timing the market completely is impossible. So then, what is the right time? According to Fisher, the first and best opportunity to buy comes when a company is starting a new and revolutionary product or plant. Often, when a company sets up a new plant or launches a new product, in the beginning its expenses increase. It takes a lot of money and time to set up machines, train staff, and build a sales network. Fisher calls this phase the time of trial and error. During this time, the company's profit may decrease a little, and common investors start selling the stock out of fear. But for a smart investor, this is the golden opportunity. If you know that the company's product is strong and these initial problems are only for a short time, then you should buy when others are doubting the company's potential. The second opportunity to buy comes when a small, temporary problem arises with an old and strong company. Suppose a good company reports a poor quarterly result, or there's a small change in management, due to which negative news starts appearing in headlines. If your scuttlebutt tells you that the company's fundamental strength is still intact, then this fear of the market is like a discount coupon for you. Here, Fisher gives a very important warning. Do not buy a stock just because it's cheap. Often, people buy poor companies in a falling market just because their price has fallen a lot. Fisher says that the right time to buy should not be decided by price, but by the condition of the business. If the business is on the verge of rapid growth, then today's price will be cheap compared to tomorrow's. In the end, Fisher has a very interesting thought. He says that if you have found a company that passes your 15 points, then you should not wait too much. In the chase of a little cheaper, investors often let big profits of great companies slip away from their hands. So the conclusion of Chapter 5 is when a company is ready for its next big step of growth, or when the market gets scared due to a small problem of a good company, that is the right time to buy. Chapter 6. When to sell. In the world of investing, there is an old saying, "No one ever became poor by booking profits." But Philip Fisher says that this is completely wrong. According to him, selling a great stock too early is the biggest mistake that stops you from becoming a millionaire. So the question comes, should we never sell a stock? Fisher says that there can be only 3 valid reasons to sell a stock. If you are selling a stock for any 4th reason apart from these 3, then you are destroying your wealth. First reason, when you have made a mistake in selection. Humans are full of mistakes. Sometimes even after doing full research and checking all 15 points, after some time of investing, you realize that the company is not what you thought it was. Maybe its management did not turn out to be that capable, or its competitive advantage is fading. Fisher says that as soon as you realize your mistake, without letting your ego come in between, exit that stock immediately, even if you are at a loss. Second reason, when the condition of the company changes. With time, even the best company can become bad. Maybe the company's management has become lazy, or it is no longer focusing on research, R&D, or a new technology has come which has made the company's product useless. According to Fisher, if a company is no longer passing those 15 points for which you bought it, then it is time to sell it. Third reason, when you find a better opportunity. This reason should be used very rarely. If you do not have more money to invest and you find a company that has the potential to give much more growth than your current company, only then can you sell the old stock and invest in the new one. But remember, the new stock should not be slightly better, but much more better. When not to sell. Now, let us talk about those reasons due to which most people sell stocks, but according to Fisher, those are very big mistakes. Due to fear of market fall. Fisher says that if the company is great, then do not sell just because the whole market is falling or a recession is coming. The market will go up again sooner or later, but if a good company slips away from your hands, then getting it back at the same price will be impossible. Just to book profit. People often say, "My money has doubled, now I will sell." Fisher says that this is the biggest foolishness. If the company is still growing, then give it the chance to become not 2 times, but 100 times. The hurry to book profit will never make you rich. When the stock starts looking very expensive. If the company's growth is 30% and its PE ratio has become a little high, even then do not sell it. A great company justifies that expensive price very soon through its earnings. Fisher's most famous quote is the summary of this chapter. If you have done your work correctly while buying a stock, then the time to sell it is almost never. So friends, selling is an art that demands discipline. If you can stay away from market noise and keep your focus on the company's business, then you will earn those uncommon profits that every investor dreams of. Chapter 7. The Hullabaloo about dividends. In the stock market, there is a very old belief that a good company is the one that gives heavy dividends to its shareholders. Many investors even build their portfolio just by looking at dividend yield. But Philip Fisher completely challenges this thinking in this chapter. He calls it the hullabaloo, meaning unnecessary noise about dividends. Fisher's argument is very simple and logical. He says that when a company earns profit, it has 2 options to use that money. Either it distributes that money as dividend, or it reinvests that money back into the business so that it can grow more in the future. According to Fisher, for a true growth company, the second option is always better. He says that if a company is distributing 70 to 80% of its profit as dividend, it means that it has no new ideas or vision left to grow its business. Math for the investor. Fisher explains a very deep concept. Suppose a company gives you 100 rupees as dividend. You have to pay tax on it, and you are left with less money in hand. But if the company uses that same 100 rupees in research, R&D, or setting up a new plant, it increases the value of the company, which increases the stock price. And the profit earned from the increase in stock price, capital appreciation, is often much bigger than dividend and also better in terms of tax. Fisher advises to stay cautious of those companies that give heavy dividends just to maintain a good image, even if they have to take debt for it. He considers this as misleading investors. So is dividend completely bad? No, Fisher does not say that. He says the dividend should only be given when all the reinvestment opportunities are exhausted and still money is left. An ideal company is the one that retains money for its growth and still, if something is left, gives it to shareholders. But as an investor, your priority should be to see what the company is doing with the money that it did not distribute. If that money is being used in the right place, then in the future it will build a very large wealth for you. Fisher's conclusion is very clear. Do not chase dividends, chase growth. Companies that retain money and invest it wisely increase their stock price so much that it gives many times more profit than any dividend. So friends, the next time you see a company's dividend yield, ask yourself, is this company going to become big in the future, or is it just distributing money because it has no plan to grow further? Chapter 8: 5 Don'ts for Investors. Philip Fisher believed that to succeed in the stock market, it is not enough to just choose the right companies, but it is also important to avoid those common mistakes in which 90% of investors get trapped. In this chapter, he tells 5 such don'ts that can save your capital from sinking. First don't: do not run behind new companies, promotional companies. Often, investors get very excited about new companies or new listings, IPOs. They feel that maybe they have found the next Amazon or Google, but Fisher warns that investing in such companies which have neither any track record nor have earned profits on a large scale yet is like gambling. Lesson: always choose a company that has proven its business model for at least 2 to 3 years. Second don't: do not leave a great stock just because it is trading over the counter, that is, on a small exchange. In Fisher's time, some good companies were not listed on the main exchange. In today's context, it means do not ignore a good company just because it is still very small or appears in the category of penny stock. If the company's fundamentals, 15 points, are strong, then no matter where it is trading, it is gold. Third don't: do not buy a stock just because you liked the tone of its annual report. Many companies make their annual reports very flashy and attractive. Fisher says do not get trapped in smooth talks of management or beautiful graphs. You have to see the truth behind the papers. Lesson: focus more on what the company is actually doing than what the report is saying. Fourth don't: do not assume that if a stock has a very high PE ratio, that its future growth is already priced in. This was Fisher's most revolutionary thinking. People often think that if a stock is expensive, high PE, that it should not be bought. But Fisher says that if a company has the potential of tremendous growth for the next 10 to 20 years, then today's expensive-looking PE will prove to be very small in front of future profits. Lesson: if the speed of growth is faster than PE, then the stock is never expensive. Fifth don't: do not get stuck in small profits for the sake of 1 or 2 rupees. Many times investors want to buy a stock at 100 rupees, but it is available at 101 rupees. They wait for it to fall by 1 rupee, and in this process that stock goes from 101 to 200. Fisher says that if the company is great and you're holding it for the next 10 years, then a small difference in price does not matter. Lesson: if the fish is big, do not argue too much over the price of the bait. Fisher teaches us discipline. He says avoid the glitter, go deep and look at the big picture. Small greed and superficial information are the biggest enemies of an investor. Chapter 9: 5 More Don'ts. Philip Fisher knew that investing is not just a game of mathematics, but also a game of psychology. In this chapter, he catches those subtle mistakes that even smart investors end up making. Number 1. Do not blindly run behind diversification. Most experts say, do not put all your eggs in one basket, but Fisher has a completely different opinion here. He says that too much diversification, over-diversification, is actually a sign of fear and ignorance. If you invest in 50 companies, you will not be able to understand any one company deeply. Lesson: instead of 20 average companies, it is better to hold 5 outstanding companies that you know inside out. Having too many companies does not reduce risk, but your profit becomes average. Number 2. Do not stop investing due to fear of war or global tension. Fisher observed that whenever there is war or major political disturbance, investors sell stocks out of fear. Fisher's argument was that during war, the value of money decreases, inflation increases, and in such a situation, instead of holding cash, being part of a strong business is safer. Lesson: selling in fear is the biggest mistake. History is witness that great companies bought during times of crisis give the biggest returns in the future. Number 3. Forget past successes or failures. Don't be influenced by what doesn't matter. Many times investors do not buy a stock because, oh, it was very cheap 5 years ago, now it has increased a lot. Fisher says that the past price of a stock has nothing to do with its future potential. Lesson: do not see where the stock has come from, see where it will go from here. Number 4. When you are buying a growth stock, do not focus too much on timing and price accuracy. Often people think, I will buy this stock only when it falls by 5%. In this process, they let the greatest companies in the world slip away from their hands. If you are investing for the next 10 years, then a difference of a few rupees will not make a big impact on your final profit. Lesson: if the company is right, then the right time to buy is now. Number 5. Do not follow the crowd. When the entire market goes crazy behind one sector, then understand that there is danger there. Fisher says that to become a successful investor, you have to think differently from the crowd. You have to find those companies which people are ignoring today, but whose fundamentals, 15 points, are loudly saying that this is the star of the future. Fisher inspires us to become an independent thinker. He says that only by getting out of the trap of fear, crowd, and past data can you reach uncommon profits. Chapter 10: How I go about finding a growth stock. Till now, we have understood the 15 points, methods of investigation, and major mistakes. But one big question is still in the air: where to start? How to reach those selected companies out of thousands of companies? In Chapter 10, Philip Fisher gives us his personal roadmap. He explains what steps he himself takes to find a multi-bagger stock. Step 1. Screening for ideas. Fisher says that he does not waste his time on average companies. First of all, he uses his network. He talks to successful businessmen, scientists, and researchers and asks them, which company is doing the most outstanding work in your industry these days? Lesson: you should also focus on those sectors where something new is happening, like in today's time, AI or EV. Step 2. Preliminary study. Once a name comes up, Fisher does not go directly to its office. First, he studies its annual reports and financial records of the last 5 to 10 years. He checks whether the company has increased its sales even in difficult times. If the numbers do not show strength, he stops right there. Step 3. The Scuttlebutt, the real work. This is Fisher's most favorite part. When he feels that the numbers are good, he starts his investigation. He meets at least 5 to 10 competitors, ex-employees, and vendors of that company. He asks them questions that no analyst asks, Like, if you were not working in this company, then in which other company of your industry would you invest? Only if he gets a positive response from here, he moves forward. Step 4. Meeting the management. Fisher says that meeting the management is his last step, not the first. He does not go to management until he knows everything about the company. While meeting the management, he checks whether they accept their mistakes. Do they have any solid plan for the future, or are they just talking sweet? For Fisher, the honesty of management was above everything. Step 5. The final decision. Only if a company passes all these 4 stages, Fisher invests. He says that such companies are found only once or twice a year, but when they are found, he puts his full strength, big investment into them, and then does not sell them for decades. Fisher's method teaches us that investing is not a part-time hobby, but a discipline. He shows us the path of hard work instead of shortcuts. So friends, today you learned those decades of experiences of Philip Fisher, which even today the world's biggest fund managers keep secret. See, it takes us weeks of hard work to create such research-based content so that you can get the knowledge of thousands of pages in just a few minutes. If you felt that your knowledge increased even by 1% today, then do give this video a like. Your one like and subscribe tells us that we should keep working hard like this for you. In the next video, we will decode what is the psychology behind making money, a book that will tell you that becoming rich is not luck, but a mindset. If you want to join us in this journey of your financial freedom and do not want to miss the summary of those valuable upcoming books, then subscribe now and press that bell icon. Do write your favorite chapter number in the comments so that I know you stayed with me till the end of the video. Keep learning. We'll meet in the next masterclass.
You are watching Inside Wealth Files.